Imagine you walk into a shopping mall. After walking around and shopping for a while, you start feeling a little tired. So you head over to the food court to grab something refreshing. You notice a stand selling ice cream and fresh fruit juice. When you look at the menu board, you see that the ice cream costs $5 and the fruit juice also costs $5. Now you're standing there wondering what to buy. The seller notices that you're unsure and says, "Hey, why don't you try our special dessert bowl? It has ice cream, fruits, syrup, and a bunch of toppings. Only $10. It looks fancy. It looks exciting. So you decide to buy it. But here's the interesting part. If you think about it carefully, the seller didn't actually use a full portion of ice cream and a full portion of juice. They probably used half of each, added some cheap toppings, and sold it as a premium combo. The result? The seller makes a much higher profit, while you pay double for something that's basically the same ingredients. It's a brilliant business move for them, but a bad deal for you. Now imagine something exactly like this happening not in a food court, but in the financial world. Welcome to the financial combo meal. In finance, insurance, and investing are two completely different products, designed for completely different purposes. Insurance is for protection, investing is for wealth creation, but many financial agents sell them together in one package. They use attractive names like guaranteed return plan, money-back policy, wealth insurance plan, or unit-linked insurance. Just like that fancy dessert bowl in the mall, these products sound incredibly impressive during a sales pitch. They promise the convenience of hitting two birds with one stone, but when you break them down mathematically, they are almost always less effective than buying insurance and investing separately. You end up compromising on both fronts. If these products aren't that great, you might wonder, why are they so incredibly popular? Why do so many agents aggressively promote them as the ultimate financial solution? There are two simple reasons. First, financial literacy. Many people don't fully understand the math behind personal finance, which makes the promise of a guaranteed all-in-one package very easy to sell. Second, and more importantly, these bundled policies usually pay very high commissions to agents. Often 30 to 40% of your first-year premium goes directly into the agent's pocket. So naturally, agents are highly motivated to recommend them over pure term insurance, which pays them almost nothing. The incentive structure is built against you. But what do customers actually get when they sign up for these? When you buy these bundled plans, the reality hits hard years later. The insurance coverage is usually very low, and the investment returns are often worse than simple savings accounts or index funds. In many cases, the returns barely keep up with inflation. So you end up with weak insurance and weak investments at the same time. Let me share a real-life example to show you exactly how the math works against you. I've seen this personally within my own family. In my family, someone bought a traditional policy decades ago, thinking it was the ultimate safety net. When it finally matured, the payout looked like a large sum on paper. But then, we did the math. The actual annual return was less than 2%. That is less than a basic savings account. The policy was tax-free, but as I said, tax-free doesn't mean profitable. You were actually losing purchasing power every single year. Why was the return so low? Because of the hidden plumbing of these combo meals. When you pay your premium into a ULIP or endowment plan, your money doesn't all go to work for you. First come the premium allocation charges, then the policy administration fees, then mortality charges. These are taken out before a single cent is invested. Your compounding engine is starting with a half-empty tank. Then there's the sum assured trap. These plans typically offer coverage that is only 10 to 15 times your annual premium. For many, that results in a life cover that wouldn't last their family even 2 years. It's a false sense of security. But the real silent killer is inflation. Because these are fixed-sum contracts, the huge payout promised 20 years from now will buy significantly less than it does today. Time is literally eating your money. At a modest 6% inflation, the value of your money halves every 12 years. That guaranteed maturity amount of $100,000 might only feel like $30,000 when you finally receive it. This brings us to opportunity cost. This is the wealth you didn't build because your money was trapped in a slow-moving endowment policy instead of a high-growth index fund. The difference between a 4% return and a 10% return isn't just 6%. Over 20 or 30 years, because of the magic of compounding, the difference is often hundreds of thousands or even millions of dollars. For the same monthly outlay, the person who kept them separate could retire with $1 million nest egg, while the bundled plan holder gets a fraction of that. You are paying $1 million convenience fee, and God forbid you need your money early. These plans are financial cages. If you try to exit in the first few years, the surrender penalties can wipe out almost your entire principal. You are locked in, even if your needs change. Now that we've exposed the math of failure, it's time to build the solution. In the next part, I'll show you exactly how to calculate your true human life value and build a bulletproof protection strategy. Now that we've broken down the trap, let's build your foundation. The smartest financial move you will ever make is keeping your protection and your growth separate. This starts with term life insurance. Unlike complex bundled plans, term insurance is pure protection. It does one thing, and it does it better than anything else. It replaces your income if you are no longer there to provide it. Remember our mall analogy? This is where you buy your ice cream and fruit juice separately. You aren't paying for fancy toppings or agent bonuses. You are paying for exactly what you need. But how much do you actually need? We use a formula called Human Life Value, or HLV. It treats your future earnings as an asset that needs to be insured. It's annual income minus personal expenses multiplied by your remaining working years. For example, if you earn $100,000 a year and spend $30,000 on yourself, you contribute $70,000 to your family. If you have 30 working years left, your family needs $2.1 million to maintain their lifestyle. If that math feels complex, use the 20 to 25 times rule. If you earn $60,000, you need $1.2 to $1.5 million in coverage. Most people are tragically underinsured because they think a $50,000 policy is enough. How long should the policy last? Only until your major liabilities are gone. Usually that's age 60 or 65. By then, your mortgage is paid, your kids are independent, and your separate investments have grown enough that you are now self-insured. When choosing a provider, look at the claim settlement ratio. This is the percentage of claims the company actually pays out. Aim for a ratio above 95%. Don't just go for the cheapest premium, go for the most reliable promise. Critical tip: be 100% honest during your medical disclosure. Smoking habits, pre-existing conditions, reveal everything. A tiny lie today can lead to a rejected claim tomorrow, leaving your family with nothing when they need it most. When you buy term and invest the difference, you aren't just saving money, you are weaponizing it. Over 30 years, that premium difference can turn into a $700,000 liquid nest egg, while a whole life policy would give you less than half. Protection is the shield, but now it's time for the sword. In the final part, I'm going to show you exactly where to invest that premium difference to maximize your growth and which riders will turn your policy into a bulletproof fortress. Protection is the foundation, but now we turn to the engine: strategic investing. When you keep insurance and investing separate, you unlock the ability to invest in low-cost index funds, the ultimate wealth-building tool. An index fund doesn't try to beat the market, it is the market. By buying a small slice of the top 100 or 500 companies, you are betting on the collective growth of the entire economy. It is low-cost, transparent, and historically unbeatable. But not all index funds are equal. Large-cap funds are your bedrock, stable, established giants. Mid-caps are the tomorrow's giants, offering higher growth with moderate risk. Small caps are the rocket ships, highest potential, but also the most volatile. Historically, mid-caps have been the sweet spot for long-term investors. Over 20 years, mid-cap indices have often outperformed large caps by 2 to 3% annually. Over a lifetime of investing, that small edge turns into a massive fortune. Let's look at the math again. If you invest $500 a month at a 12% return over 30 years, you don't just have a nest egg, you have nearly $1.7 million. That is the power of the difference you've been investing. Now, to make your fortress bulletproof, you need the right riders. First, the critical illness rider. Unlike health insurance, which pays the hospital, this pays you a lump sum of cash upon diagnosis of a major illness like cancer. It protects your income when you can't work. The second essential is the waiver of premium rider. If you become disabled or seriously ill, the insurance company waives all future premiums while keeping your full life cover active. It ensures your family's safety net never disappears, no matter what happens to your health. So here is your final masterclass checklist. 1. Buy a pure term life policy for 20 to 25 times your income. 2. Add CI and waiver of premium riders. 3. Invest the premium savings into a diversified portfolio of index funds. 4. Stay the course for 20+ years. When your agent tells you term insurance is a waste because you get nothing back, remember, you aren't looking for a return from your insurance. You are looking for protection. You get your return from your investments, where the math actually works in your favor. The big lesson is simple, but life-changing. Don't fall for the financial combo meal. Insurance is your shield. Investing is your sword. When you keep them separate, you win. You get the highest protection and the greatest wealth possible. If you're ready to upgrade your brain and take control of your financial future, join our community. Comment cheat code below to get our free insurance buying checklist. Together, we build wealth that lasts generations. I'm Manuel Johnson, and this is Red Snows.